the Fed's preferred inflation gauge coming in broadly in line with expectations as investors await the Fed's next move on interest rates. The CME FedWatch tool showing 42% still expect a rate cut to come in September. Now, for more on this, we want to bring in Ryan Wang, HSBC U.S. economist, joining us now here. Ryan, it's great to see you. So talk to me just about how you're looking at this print here. It's in line with expectations, although spending a bit weaker than initially anticipated here, also was revised lower the previous month. Are you looking at this print as a bit dovish, or how do you see it?
Thanks so much for having me. Well, I think most of the focus going into this number was on this core PCE inflation number. In monthly terms, the expectations were very, very close for either a 0.2 or a 0.3. And then in yearly terms, it was a close call between 2.7 versus 2.8. And what we ended up getting was a mix. So the monthly number rounded down to 0.2. So on the margin, the Fed will be happy with that. But on a year-over-year basis, the core inflation rate stayed at 2.8%. And so that really doesn't indicate much progress on disinflation this year. Of course, core inflation is much lower than it was a year ago. But this year, we've basically seen a little bit of a stalling out in that key metric close to that 3% level.
Yeah, continuing to think about some of the factors that played into the real PCE number, the largest contributors to the decrease that we actually saw in real PCE in April of about 0.4%, or 0.1% decrease overall in real PCE. Largest contributors there were gasoline, other energy goods, motor vehicle fuels, lubricants, fluids, whatnot, and recreational goods and vehicles. I mean, all these things considered, those are some of the more kind of volatile or moving assets or parts of this report. So just what does the real view picture of this part of the equation look like?
Yeah, you're absolutely right. This is a little bit of a confusing report because on the one hand, it's telling us about real consumer spending, real consumption. But on the other hand, it's also telling us about inflation, about prices. So you're right. On the real side, I would say generally the U.S. economic momentum has surprised to the upside this year. Consumer spending has broadly continued to stay resilient. However, in the last 1 to 2 months, the growth has been a little bit more limited. The April retail sales number was a little softer, and that translated into basically little to no change in so-called real PCE in the latest data for April. So I think it's a mixed picture. In general, I think you have to say that consumer spending is still staying resilient. But when you think about this question of will the Fed cut, when will the Fed cut? Well, they're monitoring both the real economy and the inflation side, right? And so as we go through the rest of this year into the second half, do we see further signs of softening in consumer spending? Do we see signs that consumers have had enough with high price levels and are needing to scale back some of that discretionary spending?
Ryan, what do you think is most likely here, just in terms of what the Fed is going to do between now and year end?
Well, what we've suggested is that if we talk about this year-on-year core PCE rate, that rate may need to fall to about 2.5% for the Fed to deliver just an initial rate cut. And on our forecast, we see that as a very close call. We basically have core inflation just maybe getting close to that 2.5% level. And so this is one of the reasons why we expect only a single 25 basis point rate cut from the Fed at the September policy meeting. Right? I think really the Fed needs to see that we're down to 2.5%, getting close to that 2% level to deliver a sequence of rate cuts. Keeping in mind, of course, the other possibility, which is that growth were to significantly soften. But under our scenario, we expect just that one rate cut this year, followed by an additional 75 basis points of rate cuts in 2025.
All right, Ryan Wang, great to get your perspective here. HSBC's U.S. economist. Thanks so much, Ryan.
Thank you.